Hi everyone, thank you for joining me. My name is Lance Norquest, Investment Advisor with Bellwether Wealth. And today on the Optimized Wealth Series podcast, we are covering tax moves that reflect your values. Today, I want to really dive into, what are some more impactful year-end tax strategies that you could start to leverage now as we're well on our way through the end of the year. And while there's a number to cover, some of the big ones that you should really focus on are capital gains management. One of the bigger, more popular ones that you hear a lot of is tax loss harvesting. For those that are unaware of what that is, essentially what you're doing is if you have an investment that has an unrealized loss, meaning you paid more for it than what it's currently worth, you could sell that position today and what they call realize that loss, and then use that loss to offset current gains that have been realized through your portfolio year to date. So what's nice about tax loss harvesting is that we can offset any of the realized gains year to date with those losses. If you happen to realize more losses than you have gains, you also have a few options with those losses. One, you can offset your ordinary income by up to $3,000 this year. Additionally, you can also bank those losses and carry those forward into future tax years to offset future realized gains. Another topic or item regarding capital gains management that we don't hear as much of, but it still can be very beneficial to you, is tax gain harvesting. Now, it sounds kind of opposite of what we just mentioned, and it is. Think about it this way. What if you're in a lower income or lower tax year this year, and you have some higher appreciated assets or investments or stocks in your portfolio? Now could be an advantageous time to sell those highly appreciated investments, realize some or all of that taxable gain in these lower tax or lower income years, rather than continuing to carry it forward and realizing it in potentially a much higher tax or higher income year. Other strategies that could also be deployed are in the form of charitable giving. One of those ways could be gifting highly appreciated stock. Again, as we mentioned earlier, you could realize that gain, pay taxes on it, or another option is a lot of charities are now accepting stock gifts. You may gift the stock and its appreciated unrealized gain to the charity and allow them to benefit from that amount while you are giving that substantially, hopefully larger dollar figure. You also don't have to realize that gain on that investment, meaning you are gifting to a charity, but you're also not realizing it or paying the taxes on that realized gain. Something to keep in mind as we're gifting to charities, though, is a standard deduction. Standard deduction is quite high. It's been high since Tax Cuts and Jobs Act, and now with the recently approved One Big Beautiful Bill, we're going to continue to see the standard deduction higher than what we've seen in historical years. So in some cases, it may not make sense for clients, or they may not see the full benefits of gifting by just doing a little bit here or there. So there's another strategy within charitable gifting called bunching. What you can do is bunch or put together multiple years worth of gifting into one. And by doing so with some planning, you can essentially put years worth of gifting into one gift, or it would go into something called a donor advised fund account, which would allow you to take the deduction this year, in this tax year, when you do the gift, but you don't necessarily have to gift the shares or the value or the cash or whatever you've put into this donor advised fund account in that year. It would allow you to trickle it out through the years. So again, you're able to bunch, what is it, 2, 3, 5 years, whatever you're available or able to get that deduction in this year. And that's especially important for individuals that have higher than expected tax years or higher than expected income years. and charitable gifting is a part of their overall financial goal and strategy. Some other things to consider, also along the lines of charitable gifting, are Qualified Charitable Distributions, or QCDs. For individuals that are 73 or older that have pre-tax IRA or employer retirement accounts such as a 401k, you are now required to take something called a required minimum distribution, or RMD. When you take an RMD, you're going to have to pay income taxes on every dollar that's taken out for that year. For some individuals, they may not need to take the money because they have other cash flow coming from other accounts, or they may not need the money altogether, but they're still required to take it, especially once you're into those RMD ages. Instead of taking the money and paying ordinary income taxes, another option is to do this QCD, or again, Qualified Charitable Distribution. You're able to gift that what normally would be RMD to a charity, and you are not required to pay taxes on that money. So again, it's allowing you to gift and be efficient and not have to, increase your ordinary income, if you will. Rather, if you would have taken the RMD, it would be, again, the money would be taxed as ordinary income, at ordinary income. Switching gears, but kind of staying on the subject, again, RMDs, or required minimum distributions. Remember to take those. For individuals that turn 73 this year, this would be the first year that you have to take an RMD. Technically, you do not need to take it before year end or calendar year end. You can wait until April 1st of 2026 to take your first RMD, or April 1st of the following year that you turn 73 before you have to take your first one. That said, if you turned 73 this year and waited until 2026 or April 1st of 2026 to take your RMD, not only are you taking an RMD for 2025 and 2026, but you're also taking the 2026 RMD in 2026, or essentially two RMDs in one tax year. For some, that could be very beneficial because that might be a lower than expected income or tax year for you. Others, that might not be advantageous, or it could be impactful having two RMDs in 1 year. So something to consider if you turn 73 this year. Should you take it this year, or tax year 2025, or should you postpone it and push it to early 2026? Again, for those individuals that are 73 or older that have already started and are taking RMDs, or required minimum distributions, don't forget to take your RMD. There are penalties if you do forget, so make sure that you're taking those. Again, those are calculated using predetermined calculations by the IRS, or Internal Revenue Service, using the previous year's balance of that account. So again, they're going to look at the balance for this year, 12/31 of 2024, and then that predetermined calculation will tell you how much you need to take. Something else to consider is, if you're taking an RMD, any taxes you withhold at the federal or state level also count towards that RMD. The net amount that gets deposited into your checking or savings account, or wherever you decide to put that RMD amount, is not the amount that is counted towards satisfying that RMD. You can also use, again, the taxes that are being withheld to help satisfy some of that as well. For those individuals that are still working, now's a good time to take a look at those 401ks or other retirement plan accounts offered through your employer and see, do you have any room left to maximize maximize the amount that you can contribute to that type of an account. 401ks, the standard contribution for tax year 2025 is $23,500. And for individuals that are 50 or older, they can do a catch-up contribution of an additional $7,500, or $31,000. Something new for this year that came from Secure Act 2.0 was what we'll call a super catch-up contribution. For individuals that turn 60 to 63, they can do a catch-up contribution of $11,250, or a total of $34,750. So again, if there's some room left in your 401k or your retirement workplace account, you may want to look at maximizing that before the end of the year. Because again, contributions reset at the beginning of each year. Something else to consider are contributions to IRAs or non-workplace sponsored retirement accounts, such again an IRA or a Roth IRA. Some of you may want to contribute to a Roth IRA, but your income exceeds the limits to do a contribution. Well, the good news is there are strategies for still allowing those higher income individuals to contribute to a Roth IRA. One of those happens to be the backdoor Roth contribution. Now, some important considerations should be taken into account, and I would highly advise you work with a qualified tax professional and or financial professional to make sure that you are doing it in an appropriate manner. There are things that you need to consider, such as do you have existing IRA pre-tax dollars, or is it all in a workplace retirement account? Because the IRS does look at backdoor Roth contributions, and the way that those contributions are made, you want to make sure that you're not triggering something called the pro rata rule. So again, I would highly encourage you to work with a qualified professional if you're considering a backdoor Roth contribution prior to then just executing such transaction. You know, we've talked about a number of topics here today. A lot of them can be impactful from a tax standpoint for you as an investor. But at the end of the day, you don't want to let the tax tail wag the dog, or as I've also said to clients, you don't want to spend dollars to save pennies. We want to make sure that our first priority or our first objective is always, what is your long-term plan? Taxes will always be here, taxes will always be a thing, and they will always continue to change. So it is important to keep it in mind as we're doing planning, but we don't want to let these short-term things affect our overall long-term picture or our long-term goals. And at Bellwether Wealth, we offer the services, the expertise, and we have the capabilities to help individuals navigate those waters and help you determine if some of these impactful tax moves can be beneficial to you, or if the juice isn't quite worth the squeeze. Again, it all comes down to making sure that your long-term plan or your investment objectives are being met before we start letting the latest and greatest rules and regs around tax planning dictate some of that. That's all for today's episode. Thank you for joining me. Again, my name is Lance Norquest with Bellwether Wealth, and I look forward to speaking with you in the next episode. Thanks, and have a good day.